You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network. I'm your host, Kerry Lutz. Well, volatility, all the markets comings and goings. How are you supposed to deal with it? Do you just put everything into cash, or do you look for alternative strategies? That really is the question. And David Jaffee is here with us now from beststockstrategy.com. David, it's great to have you on the show. So what is a poor investor to do at this point? How do you protect your gains that you might have had over the past decade? And how do you do this defensively, I guess, is the question.
Yeah, that's a great question. I think in general, they need to make sure that they hedge and that they take the opposite side. So during periods like we had in 2021, when the market went up about 30 or 35% and stocks were hitting new highs, during those times, it's wise to be a contrarian and actually end up buying puts, especially because when every stock is hitting a 52-week high, then volatility is usually low. The VIX is trading at around 15. And as a result, you can buy options. You can buy put options on the SPY or SPX that are about 2 years in duration. And then that will then help reduce your portfolio volatility. I think that right now, where many stocks are down 40 to 60%, it is pretty difficult to hedge right now, especially because VIX is trading at around 27. So that protection is going to be very expensive. I would actually say that one of the better moves that could be made now, I know that it sounds crazy, but it would be to, again, take a contrarian viewpoint and to actually buy leaps, to buy long-dated calls. Yeah. And the reason for that is I believe that many stocks like Amazon or Microsoft or even something like NVIDIA, which I know as of this moment, I think it's down around $10 today or 11, and it's down to around 140 when its 52-week high is about 346, I believe. But it is good to be a contrarian. And when everyone is super scared, then that might be the time to actually buy shares or to buy calls. It's kind of similar to what Warren Buffett says about being greedy when everyone's fearful and fearful when everyone's greedy.
Right. Okay. So when there's blood in the streets, that's when you need to be bold and a contrarian, right?
Yeah, and then also it works on the opposite end when everyone is euphoric and negative news that comes out is disregarded and the stock market continues to go up. I think that many people, they don't want to think negatively because they look at their account and it's going up every single day and it makes them feel good. It gives them a sense of accomplishment and it makes them feel like they're skilled.
Yeah.
But the reality is that during that time, during periods of euphoria, when your account is growing every single day, what disciplined and what experienced investors are doing during those periods is they're actually buying protection, long-dated protection to reduce portfolio volatility. Because as we've seen, the market goes down a lot faster than it goes up, a lot faster.
Yeah, it goes up on an escalator or a stairway, and it comes down on an elevator, right?
Yeah, exactly. Yep.
But many of you out there, and myself included, little wary of options because 95% of everybody who buys options loses, right?
Do they? I mean, I'm not sure. I know that with statistics, it's easy.
The vast majority lose money.
I think that you can make a claim that the vast. I've read studies where like 99.8% or something of day traders lose money. I think there was a study from Brazil, and then which looked at like a few thousand, and I think there was a study in Hong Kong that looked at like 360,000 like day traders. But at the same time, I think that when you sell options, you're basically agreeing to buy a stock at a lower price than it's currently trading for. So as long as you don't trade too big, because there is significant leverage and you have that correlation risk. So technically speaking, I mean, let's say you wanted to buy Amazon and Amazon's trading at like 125. You could basically sell a put option, which gives you the right to purchase Amazon at the price that you want, at your strike price. So for example, if you wanted to buy Amazon at 120, you could agree to buy Amazon at 120 by selling a 120 put, and you can collect about $1 or $2 for that. So that means that your net price, your net acquisition price is going to be about 118 or 119. So you're effectively agreeing to buy a strong, high market cap stock with a desirable and recognizable brand below the current market price. Where people get into trouble is with the leverage component. So if they sell too many options and then the stock market falls by 20 or 30%, then they might be forced into a margin call and they might be forced to close out the positions. On the buying side, we all know that buying options, it's a low probability trade, meaning the probability of profit when you buy an option is going to be less than 50%. And the reason for that is that the expected volatility is almost always more than the actual volatility. So because of that, then you're actually paying for that time premium, and you're also paying that difference between the expected and the actual volatility. However, I think that during times like now, when the market is down, and many stocks are down 40 to 60%, I think that the odds are in your favor if you buy a leap on the call side for Amazon or like the Qs or something of that nature. Will it definitely make money? Of course not. But there's no certainty when you're investing.
Hey, so just define for us, for those of you out there who aren't really familiar with options, what is a leap and why is it beneficial to be looking at them?
Don't just survive, thrive. The Financial Survival Network.
Goldterra Resource Corp is a gold exploration company that has assembled a highly prospective district-scale land position on the doorstep of the city of Yellowknife in Canada's Northwest Territories. Goldterra is currently focused on expanding and delineating gold resources at the company's Yellowknife City Gold Project with a goal of discovering over 5 million ounces. With ready access to infrastructure and multiple high-grade gold discoveries, Goldterra is on track to re-establishing Yellowknife as one of the premier gold mining districts in Canada. Goldterra trades as YGT in Toronto and YGTFF on the OTC. For more information, go to goldterracorp.com. That's goldterracorp.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
So I generally speaking, to be honest, I'm not really a big fan of buying options. I think that it's imperative to buy options on the put side for portfolio insurance. And then also when the market is oversold, it's worthwhile to buy long dated call options. But in general, I am an option seller. But regarding what a leap is, I do think, let me take a step back. I think it's important to buy options, whether it's puts or calls, at market extremes. Now, the market doesn't ring a bell at the top or the bottom, so we kind of have to guess. We have to make an assertion of whether we believe the market is oversold or overbought. In this moment, I do think that the risk reward is favorable for buying long dated call options. And to answer your question directly, a leap is just simply a call option that has a very long expiration. So if you went out like a year, or I think some stocks actually have 2-year expirations, then by buying that leap option, because right now a lot of stocks are about 50% off of their high, then figure that the market can recover, and then those long dated call options will show you a very large gain. So I think that at market extremes, you can buy a long dated call option, which will, let's say you bought a call option on Amazon that expires in 2 years with a strike of 150. Well, I think Amazon's 52-week high just like 7 months ago was about like 185, around there. So by buying like the 150 or 160, you'll pay a little bit of money, and then you're giving yourself a lot of time to be right. And you're figuring that, okay, right now things might not be good, but in 2 years, then I believe that this company will be trading higher than it is right now.
Okay. How do you, what kind of option strategy would you use for, say, Tesla?
For Tesla,
Yeah.
I don't really trade Tesla that often because I do feel that, and I think that we discussed this last time. I think that Tesla is a great company, but I'm also a little bit wary of stocks that have like rock star CEOs. In this situation with Tesla, I would probably, and I know that it recently had a split, I would make a decision and ask myself, at what price do I feel comfortable owning the shares of Tesla?
Mm-hmm.
And then I would either sell a put option so that way I can collect premium and continuously sell puts on it so that I can collect more and more premium. Or if Tesla falls below that strike, then I can simply take ownership of it and own it. Or if you believe that Tesla right now is drastically oversold and that it's going to go up tremendously in the future, which it has been one of the best performers in the market over the past 5 years, then you could buy call options that are long dated, that are like 1 or 2 years out.
But you're going to pay, obviously, a pretty heavy premium. How do you know when the premium that you're paying is reasonable or it's too high?
Oh, I mean, that's a great question. You have to assume that reasonable is something that's in the eyes of the actual trader. So we do know that it's an efficient market, especially when you have something like Tesla and Amazon or something that has significant volume. There's no free money out there. So the bid-ask spread is going to be narrow. And then also the options are going to be priced relatively accurately. I think it really just it comes down to your perception of thinking about whether something is oversold or not. I mean, if you look at something like NVIDIA, people bought it at 360 and currently it's trading at 140. And NVIDIA is, it's a legitimate stock that has been one of the best performers up until recently. So you have to ask yourself, do you believe in the long-term prospects of NVIDIA? If you do, and because the implied volatility on NVIDIA is high, then you can either sell a put option with a strike of about 120 or 130 and collect a decent amount of premium. And then if that strike gets penetrated or challenged, then you can take ownership. Or if you believe that basically NVIDIA at 140, it's going to bounce off the bottom, then you can just buy call options. You can either buy like a 170 call option that's like 1 or 2 years out. Or if you wanted to pay less money, you can even buy something that's further out of the money. You can buy like a 200 call option. But there's no way of knowing for sure.
Right. But supposedly there's algorithms. The big guys figured this stuff out and they sell them overpay.
They sell them what?
Ever overpay premium wise. The pros.
Yeah, I mean, that's news to me. I know that a lot of a lot of institutional traders, they're making money as market makers. So you have like the Citadels and the Goldman Sachs. They're basically and effectively making like risk-free profits by matching up the bid and the ask spread differential and profiting like, 1/100th of a cent for every share or every contract that they sell. Regarding like proprietary hedge funds like Renaissance or things of that nature. I mean, most hedge funds do fail. I know that Renaissance does extremely well. I'm not really privy to their strategy, but yeah, I mean, for retail traders, I don't think it serves retail traders to think that there's like a magic solution or a magic trading system out there. Because the reality is that, you're going to make money based upon making good decisions. Right.
All right. Well, interesting things to consider. I think caution nowadays is definitely the byword. Hey, we want to find out more about you, connect with you on the web. Where's the best place? The website or go on Twitter, social media?
Yeah, you can catch me on my website at either beststockstrategy.com or davidjaffee.com. Also, I have a YouTube channel, youtube.com/beststockstrategy. And you can also send me an email, on my website. I try to respond to everyone, and I'd be happy to answer any questions that you have.
All right. Excellent. Well, we really appreciate you coming back on, David. It's interesting times. I guess you need to be doing things differently. That's the key. And if you've got a question for David, shoot me an email, kl@kerrylutz.com. Don't forget, go over to the website and sign up for the free newsletter, financialsurvivalnetwork.com. David, we will talk to you again real soon.
Thank you so much for having me. Have a great day.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.